Hey guys, David Ross from Direction Accounting and Business Coaching. Following on from our What is Tax Planning video, I wanted to follow up with some of the key strategies that we look at when we're talking to a business owner about their tax planning. In particular, some of the ones that are key for 2021, the year that we're just about to do. So the first of those is the instant asset write-off, the one that everybody's talking about. So the full expensing of assets. So if you buy something for $160,000 that's for your business, an asset for your business, you can write that off 100% in the year that's just about to finish. Sounds like an amazing tax benefit, yeah? It's really misunderstood. So I actually think this one is possibly some smoke and mirrors by the government. I always have thought that with the instant asset write-off. The reason why is that normally if you bought an asset that was $160,000, you would depreciate that over a number of years. So you would get the deduction not only this year, but also next year and the year after, maybe the year after that. So you get a portion of that cost in each year. Now, what's happening with the instant asset write-off now is that we can claim it all in 1 year, which is great if your business has got the profit that needs to write that off. But even then, in future years, when you turn around and maybe dispose of that asset, you've got no cost left. So whatever you dispose of that asset for is going to come back and bite you in the future as a profit on sale. So you're really going to need to watch that if you're going to apply this. The other thing about the smoke and mirrors is that you're not really getting anything that you wouldn't normally get anyway. So whilst you're getting a deduction in one hit now, dependent on your tax rate and dependent on the value of the item, you're really not getting any more than you would get if you divvied it up over maybe 3 or 4 years worth of normal depreciation. So there's no real long-term gain in there. It's just a timing difference. And the big thing about the timing difference is that you need to make sure that you need it now and have an eye on what's going to happen in the future. So for tradies and builders who are really booming at the moment, maybe instant asset write-off is a really good thing, but they do need to watch that ultimate sale down the track. So they buy the Hilux today, claim it 100%, turn around in 2-3 years time and try to sell it for 20 or 30,000. That 20 or 30,000 becomes assessable. And you can bet that the car yards and the well-meaning accountants who are maybe giving the advice to just go and buy another car before the 30th of June are not telling them that impact. It's a very important thing to note. The other thing to note in regards to the instant asset write-off is if it is a passenger vehicle, then there's a depreciation cost limit. So even if you spend $80,000 on a passenger vehicle and you're using it predominantly for business, you won't get the write-off past the 57,000. Now, this doesn't apply, of course, to non-passenger vehicles that have over 1 ton carrying capacity. But the thing that's often neglected is the fact that even though it's over 1 ton carrying capacity, to be able to claim that without logbook information, you have to be able to say that it's predominantly for use in work. So all of these vehicles that are being claimed as non-passenger vehicles that as soon as Friday afternoon comes, jump on the beach and head off, there's a question there. Again, we're in the self-assessment system, so those who haven't had a knock on the door, they may get away with it forever. But technically, there's that issue there, predominantly used for business. So need to be very careful with that one. So all of the Dodge Ram buyers out there, maybe have a look at what you're doing and have a little bit of a think about how you're going to be able to justify the 100% use of the Dodge Ram. The other important areas of strategy that we look at is in and around superannuation. And whilst we're not giving financial advice to put money into super, that's a financial planner's job. What we do is we say, well, okay, look, the tax ramifications of putting money into super are such. Now, when money goes into super, it gets taxed typically at 15%. So if you're running a company and your company tax rate is 26%, you're putting money into super and it gets taxed at 15, you're really only saving 11 cents in the dollar. And depending on where you're at in your life cycle, you could be parking that money and tying that money up for quite a long time. So you really do need to think about that tax strategy. It only suits certain people, and again, it has to be done under understanding proper advice of putting that money into superannuation from a wealth perspective, which we engage financial planners to assist with that if need be. Last one I want to mention is this concept of a loss carryback. So as we know with COVID, a lot of businesses have been going through different phases. They might be booming, they might be really, really struggling. So the government has brought in this loss carryback concept. And what it allows you to do is if your company's making a loss, then you will be allowed to carry that loss back to a profitable year, so as you can then maybe get an offset of the tax that you had paid in that private year. So it's a little bit of an averaging process, if you like. So for instance, if you make a loss in 2021 in your company because you've had a poor year because of COVID, but prior to that you were profitable and paying tax, then you will be able to, if all other things add up, be able to carry that loss back and get an offset and get some money back from the government for tax that was maybe paid previously. So an important one to analyse with your advisor. So again, I just want to reiterate that these aren't things that you can get advice on over the fence or at the pub. These are things that you need to speak to a really well qualified accountant, not one that's just going to tell you what you want to hear, but one that's going to be able to give you the full picture and make sure that you make the right decision when it comes to tax planning. If you'd like to talk to me about how you can avail yourself of some of these tax strategies, then just comment tax below or get in touch with me at direction.com.au and we can sit down, have a look at your specific situation, because every business is different, and have a look at what we can do, time's starting to run out, before the 30th of June, and make sure that you get in the best tax position possible before the end of financial year.